I'd like to welcome Jonathan Lowe, Vice President of Growth Equities at AGF Investments. He works alongside Tony Janua at the AGF Global Select SMA and Mutual Fund. He joined AGF in 2012, if I'm not incorrect, prior to which he worked at the institutional equity research team at CIBC World Markets. One of the interesting things about your background is that you have your Bachelor of Science from Seton Hall University and your MBA from Oxford, which there's not many that I know have that. And I'd like to welcome you and thank you very much for coming out to speak to my people here.
No, thank you. Thank you for having me. It's great to join you on the line here, and happy to chat about anything in the markets or in our portfolio or anything at all.
Okay, great. Well, one of the things that I wanted to focus on is not quite the markets, because there's so much noise out there about markets right now. It seems that almost 90% of what's going on in markets today is based on macroeconomic headlines, inflation, job numbers, and such. What I'd love to hear, I'd like to get some comments on that in a bit, but I'd like to turn that off for a bit and just ask you about the portfolio of companies that you're currently managing. What is it that you see as an opportunity? What do you see out there in the environment right now?
Yeah, I agree with you. It's really hard to separate the macro in this environment because it's really been a very macro-driven environment. When you think about the past 3 years, it's been big systemic events like the pandemic and the coming back from the pandemic, and this year it's about inflation. All these things have really been the primary driver of the stock market, of stock market returns. So I think it's hard to ignore that. For us, what we're trying to do in terms of our investment philosophy is the idea of participating in market leadership. The thing about market leaders is that there's very few of them. So there was a study done several years ago by a professor by the name of Hendrik Bessembinder out of the Arizona State University. And so his study was provocatively titled, "Do Stocks Outperform Treasury Bills?" And if I gave anybody 5 seconds to answer that question, most people on the dot say, of course they outperform Treasury bills. But the actual answer is that most stocks do not outperform Treasury bills. So he looked at 26,000 stocks that was listed on exchanges since the 1920s. More than half of them had a return that was either negative or below that of the Treasury bill. But the opposite conclusion was true, which is that the market's wealth creation is generated by very few stocks. So 4% of stocks historically resulted in 100% of the market's wealth creation. And so what we're trying to do in the portfolio is really think about market leaders and try to participate in them with conviction. Now, the thing about market leaders is that it's always changing. Leadership is always changing. And the reason it's always changing is because it's influenced, in our view, by two aspects. And the first is from a bottom-up perspective, from a company perspective, has to do with innovation. And so in normal times, this is the primary driver for market leadership. If you think about the past 10 years before the pandemic, what were the leaders? It was the leaders that were innovating, the companies that were coming out with new products and services that were disrupting the way we were doing things. Something like the cloud, for instance, was started gaining a lot of a share in importance in terms of the way we communicate, the way we live every day. And so, innovation was very important for those 10 years. But there's a second aspect around market leadership, and that has to do with the macro environment, actually. I know you said to ignore the macro, but it's hard to ignore the macro because right now we're in a macro-driven environment. So sometimes market leadership shifts because of changes in the macro environment. And that has been the case in the last 3 years. If you think about, what's happened, we've had work from home stocks lead in 2020 because all of a sudden we're stuck at home. And there's a pandemic, and all of a sudden, guess what? We're relying on things like Zoom Video and DocuSign and Teladoc for medical purposes. We owned all of those stocks amongst our portfolios in mid 2020. But as I said before, market leadership is always changing. So in 2021, that started to shift. The economy began to reopen, and the stocks that did well during 2021 was a bit of a tug of war year, but there were periods when the stock market started to shift towards the more economic cyclical companies. And that was because the economy was reopening. So, a company like Zoom Video was no longer doing as well. it had pulled forward demand in the sense that it grew so much during the pandemic and was not able to keep up that same pace of growth throughout 2021, 2022. So what worked were some of those early losers. The early COVID losers became the reopening winners, like brick and mortar stores. It was energy companies. It was travel and leisure stocks. And we benefited from many of those. But this year has been a year about capital preservation. We have the Fed raising rates at nearly an unprecedented pace. We have the highest inflation in 40 years. And so we've had to reorient the portfolio. We've done a lot of changes in the portfolio. We've moved on from 2020 when we had a lot of the early COVID winners. In 2020, across our three portfolios, in each of them, we outperformed by 30% over the benchmark. And the way we're able to do that is having those e-commerce stocks, those remote work companies, those work from home companies. But in 2021, we've already changed all that. We went underweight technology, we went overweight in energy. We've had a lot of turnover in terms of our top 10 holdings because this environment has necessitated that. If you didn't change your portfolio, the better you did in 2020, the worse you've done in 2022. And so we've had to change. And this year, what we're doing is we're avoiding high valuation stocks. The reason is because high valuation stocks are under more pressure as rates rise. Higher rates are inversely correlated with valuations. So what we want to do is avoid as much as possible, and we've brought the median PE on all of our portfolios down to below that of the benchmark. We want to avoid those high valuation stocks. We want to avoid unprofitable companies. So companies that are not making money today, but have these amazing end markets, maybe huge addressable markets in the future. They're long duration stocks by definition. There may be a very promising future for them, but today is not the environment to be investing in. And so we've avoided unprofitable companies. 98% of the stocks in American Growth and Global Select, are in companies that are profitable today. And we have more dividend payers as a result, because we're investing in companies that have profitability today, that are more mature and have earnings, and therefore they're able to return cash to shareholders. And then last but not least, I think more recently what we're doing is prioritizing earnings visibility. And the reason is because I think when you think about where we are today, we're going to be entering a period where the economy is weak. We can debate whether or not we're going to be in recession next year, but no question we're in a slowing economy. There's Fed rate hikes. Here in Canada, there's a Bank of Canada rate hikes that have a lagged effect in terms of slowing the economy. So in that slower economic environment, we want companies that have resiliency in terms of their earnings. We think that in the coming quarters, there could be landmines out there. We don't want to step in those landmines, right? We have companies that are dealing with deteriorating demand. We have some dealing with cost inflation. We have some dealing with a stronger US dollar, which is not good for some US companies. So, we have to be careful in terms of, the companies that we invest in. So when you look at the companies in our top 10, they're all companies for one reason or another where we have high confidence that they're going to be resilient in this environment. That could be a company like Cheniere Energy, which is one of our top holdings in two of our funds. It's one of the largest US pure play liquefied natural gas companies. What we know about liquefied natural gas is that it's highly in demand all over the world, because Europe is trying to wean itself off of Russian gas. They're trying to import all the LNG they can. And that LNG is going through, is being liquid, has to go through Cheniere's liquefaction facilities, right? And that's really the bottleneck. The bottleneck is it's very hard to build these big facilities, big expensive facilities to create LNG. Here in Canada, by the way, we're building our first one. It's not going to be ready until 2025. So it tells you how long a lead time it takes to build some of these things. So, Cheniere, we have high confidence that their earnings are going to be resilient no matter, what happens. We know there's a huge demand for their product. For something like we own a company, Raymond James Financial in the portfolio. And the reason we own that is because they're one of the financial companies that are most levered to rising rates, meaning they clip a higher rate off their deposit base. They don't make loans. They clip a higher rate off their deposit base. As rates go up, they make more money, basically. And again, so we have higher confidence that rates will be higher for longer. They're gonna do okay in this environment. Something like T-Mobile, which we recently added to. That's a company that's a defensive sector. in the telecom industry. They're first mover in rolling out 5G to homes. And, they're extracting synergies from their merger with Sprint. So they have a lot of different things going for it that lead to us thinking that it's going to be pretty resilient in its earnings. So I'm just trying to give you a flavor in terms of how we're thinking through our investment decisions today. I think that as we head into next year, I think what we're going to see is progress on the inflation front by year end. We're probably going to get more rate hikes. We're having an inflation print coming tomorrow as we record this interview here. So we'll see what happens. But right now, the market is pricing in another 75 basis point rate hike in November and another 50 basis points in December. But I think that, towards the end of the year, and hopefully we do see some progress on inflation coming down, I think you're going to see a narrative emerging that the Fed is slowing down its pace of rate hikes. And that is really the catalyst that we're looking for that may result in a year-end rally. So, it's probably not going to be a V-shaped recovery either. Unfortunately, it's looking like a high probability we're going to have a shallower recession next year. So we're going to have to work through that. But I think what's important to keep in mind is that as of today, the markets, and I'm using the S&P 500 here, but most of them are about the same. The markets are already 26% off their high. So there's already been a lot of bad news priced in. And generally, I think as an investor, if you're buying the market at a 26% discount and you have some patience and you have a long-term perspective, it tends to work out pretty well over the long term.
So, yeah, I couldn't agree more, of course. But what is it that you see as opportunities in particular for individual investors at this time? If you were going to be deploying fresh capital, how would you go about doing that?
Well, I think from a market perspective, first of all, it has to do with that my last point that I made. So you think about it this way: you're buying whatever you're buying at a discount from 9 months ago, right? The markets are 26% down from that level. So to give you the context of historical market declines, the average bear market, when there has not been a recession, has been about 24%. The average bear market, when there has been a recession, has been about 35%. However, there's a high degree of variability between shallow recessions and deep recessions. So shallow recessions have usually been around in the mid-20s, and the deep recessions have been much worse. In 2008, or early 1970s, it's been 50 to 60%. So there's been a high degree of variability. Our view is that next year, our base case would be that, I think we're going to see a recession of the shallower variety. And the reason is because we haven't really seen the imbalances built up in the system that we have in previous harder recessions. We have pretty good household balance sheet strength in the US. We have corporate balance sheets are pretty strong. Credit default spreads are pretty benign. If you look at bank capital ratios, are very healthy. Credit card delinquencies, actually all kinds of delinquencies, they're starting to move up a little bit, but they're moving up from multi-decade lows. So I don't think we have the imbalances that what we're going to probably see is one of these well-telegraphed recessions caused by monetary policy tightening, which in the past has meant that the market decline has started earlier, but it's also ended earlier. And so I think for the end investor, it's helpful to keep that in mind. Our belief is that we're closer to the end of this than the beginning. I think we are in the process of making a bottom, but I'm not saying this is the bottom. We could make lower lows from here. We probably will, to be honest. But I think we're closer to the bottom than we are to the top. And I think if you have some patience, that's going to work out pretty well. If you bought the market blindly every time it was down 20%, and you had the patience to wait three years for your market return, in almost all cases, other than 2001, because we had 9/11 happen, which was a double dip. But other than that, if you wait 3 years, you're positive. Sometimes the negative 20% becomes negative 30. even negative 40. As in the case with 2008, it got worse, right? But even in 2008, if 3 years after the first point where the market was down 20%, it was positive. You were already in the green. So, those numbers, I haven't run them if you were down 26% down like you are today, but I can assure you they'd be even better. And so I think, if you have some patience, what you want to do is layer in, opportunistically. For us, we have actually more cash in the portfolios today. So we have almost 20% cash in Global Select. And what we're looking for is that sort of sell-off opportunity, and where we will be putting some of those proceeds to work. So, I think when you look at sentiment indicators, everything feels really terrible right now, right? Everybody's bearish. But I would remind your investors that that's when bottoms happen. Bottoms always happen when things feel terrible. Think about it this way. March 23rd, 2020, which wasn't that long ago, was the market bottom after COVID. But how did everybody feel that day? That was a scary time, right? People were thinking that, basically the economy might blow up because everybody was staying at home. How are all these, shops going to stay in business? We had to adapt to a new way of life. That was the market bottom. And, I think market bottoms never feel good, but that's why they're bottoms. They're bottoms because, it's the maximum point of selling pressure on the markets. And so I think it's helpful to keep that in mind. If you have some patience, I don't know where the bottom is, but you don't want to miss the best days in the market, which is usually following the worst days. And so I would advise your clients to, think about it that way. And, maybe you want to use a product that has the flexibility to seek market leadership. That's what we're trying to do in the portfolio for our unit holders.
So how quickly can you allocate capital? You're saying that you have a fairly large cash position at this point in time. How fast can you actually get that working for you if you wanted to?
Oh, right away. If we usually enter a buy position, and if we wanted to, these are usually pretty liquid securities. So we usually provide instruction for our trading desk to either work the order, which means that, try to achieve best execution. They may be a little bit more patient in terms of filling that order. But if we had to, we could fill it right away. So we always run a liquidity analysis on our portfolio, on all three of our portfolios every quarter. And so what we look at is, if we had to liquidate a quarter of the whole portfolio, how long would it take us to do that within a given level of market participation of the volume? So we want to make sure that we're participating at a low enough level that we're not moving the market. So at a 20% participation rate, for example, I don't have the stats exactly in front of me, but it's about 96% of the portfolio can be liquidated with less than one trading day. So we are, especially Global Select, it's designed to be a nimble, flexible, go anywhere portfolio. If we decide that we want to enter a position in a specific area, well, we have the dry powder to do so almost immediately. And
when you're looking around the world, of course, right now, Europe is being the hardest hit. It seems to me, a deflated market and a deflated currency. Are you seeing great opportunities there, or where do you see the best opportunities in the world right now?
Well, I would say, geographically speaking, the US is probably the best of the bad lot right now, to be honest. Europe is, as you said, suffering worse because, in fact, they're probably in recession right now. The energy costs in Europe are substantially higher than they are here in North America, because of where they are and where they get their gas from. There was question for some time whether they would have enough gas at all to make it through this winter. And now it looks like they will. The question is now next winter. But the consequence of that is that they're paying much more for their energy, to the point where many of the governments over there have had to cap their energy costs and basically subsidize their own consumers. So, I think if you're paying 15 times more for your energy bill than you were before, which is the case for many European countries, then that's going to crowd out a lot of other expenditures for your house, right? So, I think Europe is in tougher shape. China, is still dealing with its zero COVID policy, which is basically preventing the economy from achieving, from growing into its potential. My dad actually lives in Shenzhen, China, and so I get on the ground intel in terms of how frustrated he is at some of these restrictions. But I think it's obviously playing some havoc in terms of the ability for the economy to have a sustained path of growth. When they have to lock down the segments of the economy every time we see a COVID flare up. But generally, I would say what we're doing is we're mostly investing in global companies playing into global marketplaces. What we're not trying to do is say, well, we like Japan, so we're going to buy more Japanese stocks. Generally we like, global companies. So in Japan, for instance, since I use that, we own Sony and we own a robotics company called Fanuc. That's not really plays on Japan's macro environment. It's more global trends, related to areas like gaming, like semiconductors, and like robotics. And so I think geographically speaking, we're actually underweight all areas because of the amount of cash we have in Global Select. But I do think that the U.S. is the best of a bad lot right now. I think from a sector perspective, there's definitely been some sector biases because of some of the macro dynamics that I explained to you earlier. We've been overweight energy, and it's been the best performing sector, not only this year, but historically speaking in inflationary regimes. We're underweight technology because, as I said earlier, we're avoiding expensive stocks, avoiding high valuation, unprofitable companies. I think in the technology sector, there's quite a few that would, be way more expensive than the rest of the market. But I also think that if we're dealing with more economic weakness next year, we want to make sure that we have that resiliency in the earnings that I was talking about earlier. So that means we have to be constantly changing the portfolio, which we have been over the last 2 months. We've been reducing areas in consumer discretionary. Why? Because discretionary expenditures are going to be under pressure. If people are in recession, they're losing their jobs, and they're not going to spend on things like vacations. So even a company like, for instance, Wyndham, which we did very well in 2021. Wyndham is a hotel chain company and more economic hotels. What we liked about it was that it had more exposure to leisure travel than business travel. And in the early days of COVID, that's what we wanted. Business travel was slow to come back, but everybody wanted to go on vacations. But I think right now it's the other side of that coin. So business travel is back. We're going back going to conferences and stuff. But leisure travel, if you're in recession, you may not pony up for that vacation that you did last year. So we've been reducing consumer discretionary. We reduced information technology further. We got out of many of the semiconductors, and thank goodness we did, because the last couple of weeks have been really weak in the semis. And we have higher levels of cash. So I think we're looking for some of the leadership to emerge before we deploy that cash.
So basically, what led the market in the last cycle may not be the new market leaders. It's
Absolutely.
still, we're still taking a look at what market leadership will end up being at the end of the day, and and you've got to stay nimble and you got to stay ready.
Yeah. Oh, well, look, there are areas that we like, but it has to fit within our framework of being careful around high valuation stocks, right? So we like areas like 5G. I mentioned T-Mobile earlier, so that's a play on 5G. We think 5G is a great opportunity in the future because we're going to have refresh cycles related to it. We think the idea of sustainability is a long secular tailwind, right? So there's a lot of ideas around sustainability that we've been dabbling in, and we've put in some small positions into the portfolio, whether that be solar or renewables. We have lithium players, for instance, in the portfolio, which play into the growth of the electric vehicles. We think that's going to happen. We're probably still going to need oil and gas, but there's no question that 15 years from now, there's going to be a lot more electric vehicles on the road. There aren't all going to be Teslas, but they all need lithium batteries in them. So
there will be a future, is what you're saying.
Yes. There's not enough lithium, by the way, to power all these vehicles. That's why when you look at the battery chemistry for for an electric vehicle. It's lithium, it's cobalt, it's nickel, and it's copper. Well, nickel and copper have both come down, cobalt as well. The only thing that stayed high is lithium. And it's because there's a shortage of, there's not enough of it to power the future. So, that's just an example. An example of something that we don't have right now, but we like, is the idea of precision medicine. Mm-hmm. So in the future, I think as if there's a very promising future for in the world of genomics. Actually, if you think about the mRNA vaccines that have come out of in terms of addressing COVID, many of them had their start in personalized medicine. Like BioNTech was initially the mRNA vaccine, or mRNA technology was created as a way of personalized care for cancer. So I think in the future, we're going to see a lot more personalized medicine technologies. However, we're not currently invested in any of them because many of them are these long duration ideas. They're not profitable today. They have great ideas without real earnings. And, so we're going to keep an eye on these sorts of opportunities as they emerge. But, we're going to also keep in mind the macro environment that we're in. And, until such time that the Fed is no longer on the warpath of raising rates, we're going to be stepping aside from some of these high valuation stocks. So I think that's the way we're thinking about it right now. There will be a day when I think our portfolio looks much more growthy than it does today. But I think what we have to do is think about the macro with that context in mind.
So if we were to kind of sum things up in a nice, neat little bow, right now the macro environment has a lot of headwinds that is being thrown at the market. We're waiting for announcements from the Fed. Today's the 12th of October. We're getting a CPI print tomorrow that will likely move the market in one direction or another. It's anybody's guess where we're going. But there is still optimism and hope for the future, and there's all kinds of different things that are happening that can give us some hope.
Yeah, I think there's a lot of uncertainty in the macro, but the markets have reflected a lot of that already. And so it's about the change in direction rather than, it's about, bad getting less bad is a buying opportunity rather than, merely if it's good or bad. So it's right. I think right now, you're seeing a lot of negative headlines in the market, but if tomorrow, we saw a less bad inflation print, I bet the markets will be up a lot. And so you're gonna, right now there's already a lot of bad news priced in. We know that market sentiment is terrible. So what I would tell clients is that we don't know where the bottom is, but don't miss the best days. Have some patience. Let your money work for you, and think that I think as long as you have the flexibility to participate in up markets. You should be thinking about, I think over the next little while, what buying opportunities are out there because the market is on sale.
Wonderful. Wonderful. Jonathan, I'd like to thank you very much for taking some time out of your day to share some thoughts with us, and all the best for the future, and good luck.
No, thank you so much. Happy to do this anytime. And for all of, for everybody, watching this recording, thank you for your support and for your interest.
Thanks very much, Jonathan.
Thank you.